Hi folks, welcome to this video on weighted average perpetual. So again, as we've discussed already, if you're looking at calculating the cost of goods sold and ending inventory, using the weighted average cost flow assumption as well as a perpetual inventory system is one of the ways we can do that. Now, don't forget, when you have a perpetual system, you are on a perpetual or ongoing basis monitoring or calculating the cost of goods sold as well as the ending inventory. So let's see now how this works when we've got a weighted average cost flow assumption. So we're working with the same data that we started with in this question, and you'll notice here, after I account for my beginning inventory, I have another purchase. So the one thing you've got to remember, and we talked about this back in the little tips section, it says that when calculating weighted average amounts, particularly when you're dealing with a perpetual system, remember to recalculate the weighted average price each time new inventory is purchased. Why? Because you never know the next time you're going to sell, because you have to take it out of inventory at that weighted average cost that you're calculating. So now let's go see how this rule actually works for us. So here we've purchased 3,000 units of inventory at $20 a pop. We want to calculate, because it's purchase, what's the weighted average cost of our ending inventory. Because if the next transaction after October the 3rd happens to be a sale, and guess what, it is, right? If it happens to be a sale, we want to make sure that we have the most up-to-date weighted average cost so that when the inventory comes out, we're taking it out at the most recent weighted average cost. So I have the original 2,000 units in beginning inventory at $18 a pop, or 36,000, and the 3,000 I just bought here at $20 a pop, which is 60,000. So I have 5,000 units of inventory at $96,000. So if I take my 96,000 and divide it by 5,000, I get that on average every unit is in there at the average cost of $19.20. So now what happens? Now I sell 2,600 items. I don't care if they come from the earliest ones in the beginning or the ones I just bought, because I'm taking them out at the average cost. So I'm taking out these 2,600 units at the most recent weighted average cost, which is $19.20, and I'm getting now a cost of goods sold of $49,920. So the 2,400 units, okay, that are left, because I had 5,000 here, right? If I sold 2,600, I mean, it's not like FIFO. I don't care which ones they are. I'm doing everything on an average cost basis. So here I've got 5,000 less the 2,600 I sold. So I've got 2,400 sitting there at that most recent average cost of $19.20. So my ending inventory is now $46,080. So now, on October the 15th, another sale. So 1,900 sold again. I don't care which ones they are. I just know I'm taking 1,900 out at the most recent weighted average cost, which is $19.20. So I'm going to have a cost of goods sold on that sale of $36,480. And now of the 2,400 I had, I sold 1,900. So I got 500 left at that weighted average cost of $19.20. So that gives me ending inventory at 9,600. Now here we go. We have a purchase. So what do I have? I purchased 3,000 at $22 a pop. All I know is I've got 500 units left, okay, of the ones that were up here, right? Because don't forget, after I had sold 19 of the 2,400, I had 500 left. So those 500 are sitting there at that average cost of $19.20, which is $9,600, plus I've now got 3,000 at $22, which is $66,000. So now I have 3,500 units at a total cost of $75,600. So on average now, that's $21.60. So don't forget, we said every time we purchase, we got to recalculate the weighted average cost, because you never know when you're going to sell. And guess what? On October the 29th, we sold. So how much did we sell? 3,300. Now, we don't care where these 3,300 come from. It's not like FIFO, where it comes from these 500 and then 2,800 from here. No, no, no. We're removing them from our inventory based on the weighted average cost of $21.60. So I have a cost of goods sold for that sale of $71,280. And how much do I have left? Well, of the 3,500 units, I just sold 3,300, so I got 200 at that $21.60 weighted average cost, so I got $43.20 left. Now, I purchased again, last day of October, 1,800 units. All I care about is that I had 200 at $21.60, which is $43.20, plus another 1,800, which is going into ending inventory at their cost, which is $20.50 right here. So in total, I have 2,000 units, right? 200 of them at the average cost of $21.60, which gives me $43.20, and 1,800 at $20.50, which gives me $36.09. So I've got 2,000 units in ending inventory, valued at $41,220. Now, don't forget, you still have to make sure, just like we said in the earlier part of the question, I don't care if you're using periodic, perpetual, FIFO, weighted average, whatever it is, you had 9,800 units that were available to sell. You sold 7,800. So if you're not sure, add up the little numbers here in red, and that'll confirm to you that regardless of what cost flow assumption, what inventory system, you're costing 7,800 units. If you had 9,800 to sell and you sold 7,800, you got 2,000 left in ending inventory, right? So that data doesn't change. But notice here, when we did FIFO, we had 157. If you go back here, we had 157.6, right, under FIFO perpetual. But now we got 157,680. It's slightly different. Here we had 2,000 units at 2061 at 41,220. If you remember, under the FIFO system, we had that at 41,300. So weighted average in FIFO will produce different results for you. But notice the one rule we said before, the total cost of goods sold plus ending inventory will give you in total the amount that you have available for sale, the amount that you had available to sell, which is $198.9. So the cost of goods available for sale doesn't change, but the allocation of that number amongst cost of goods sold and ending inventory does change, right? So now, hopefully you're good with that, because the next thing I'm going to talk about is what if we used a weighted average periodic system. So if we had periodic, right? Don't forget, the cost of goods sold and ending inventory are not determined during the accounting period. Don't forget, you're sitting back at the end of the period and you're just saying, okay, I want to calculate my cost of goods sold for 7,800 units and my ending inventory value for 2,000 units, right? How do I do that? Well, very simply. It's even easier than it is in FIFO periodic. I know that I had $198,900 worth of stuff to sell. On a per unit basis, I had 9,800 units. So on average, the cost of goods available for sale is $20.295918. Now you would say, man, oh man, I'm just going to round that to $20.30. Notice I have a couple of question marks here, because in the accounting world, most accountants in their inventory systems would take it to as many decimal places as they could to get a more accurate number. Now for you guys in the classroom, I know your text, and I'm okay with it too, is if you rounded it to 2 decimal places. Don't round to the nearest dollar. You can round your final answer to the nearest dollar, but when you're doing the unit costs, you should round them to 2 decimal places, or for more accuracy, keep all the numbers after the decimal point. And what I did here is I showed you the difference. But first of all, before I go into the difference in the numbers calculation for cost of goods sold and ending inventory, let's just review what we're doing here. All we're doing is we're trying to find the weighted average cost of all the goods that you had available for sale. Well, the cost of goods available for sale was $198.9 divided by the number of units that you had available for sale, 9,800. So that's going to give me the unit cost that I'm going to apply to the 7,800 units that I sold and the 2,000 that I didn't. In fact, I just noticed maybe a little bit of a typo here. Weighted average cost of goods, that should probably be available for sale, just to make it a little bit clearer, right? And that's going to be this number. So if I use this number, which is the more accurate number, and I multiply cost of goods sold units by 7,800 times that number, I'm going to get 158,308. My ending inventory is going to be, should be 2,000 units, right? Times that number, and that'll give me 40,592. Now, just line this up a little bit better. If I added those two numbers together, notice I get 198.9 on the button when I add these two guys together, right? Which is what I had available to sell. That was in the question. You calculate it in the earlier part of the question. If I rounded it, then I'm going to take my 7,800 units and multiply it by $20.30 if I'm rounding to the nearest cent, and then I'm going to get 158,340, which is different, right? And then in my ending inventory, I'm going to get 2,000 units times $20.30 rounded. That's going to give me 40,600. So now what I'm going to get is 198,940. So when you round, you lose some accuracy, right? You should be getting 198.9. But because you opted to round, you're going to get 940. So you're going to be $40 different. So I always recommend to students, if, you're going to say, well, how come I'm not getting 198.9? It's because you rounded. Now, for the classroom, I don't mind that. But as a point of, professional, like what an accountant would do, we would take it to all the decimal places that we find. There are inventory systems or accounting systems that we purchase that will allow us to set the number of decimal places for accuracy, for calculating things for accounting purposes in the system. So that's how you would calculate weighted average cost of goods sold and the weighted average cost of your ending inventory under a periodic system. So this concludes our video on weighted average cost flow assumption under periodic and perpetual. I hope you found the video useful.